Okay, so today we're looking at an analysis of SoFi's record Q3 earnings, specifically digging into the case for those really high analyst price targets, some reaching up to $38.
Right.
And the material, it does a phenomenal job with the raw numbers. The 11-cent EPS, that massive 900,000 new member figure, the energy is there.
The foundation is definitely strong. But to get from a purely bullish narrative to a really robust investment case, I think the analysis needs to proactively integrate and then overcome the counter-arguments that are baked into those lower targets.
I see that. But if the whole point is to prove the $38 bull case, wouldn't focusing on the mid-20s average just distract from that? Why is it so crucial to address the bears?
Because a victory is always more convincing when you show you've beaten a real opponent.
Okay.
The weakness here is that the material acknowledges the broader skepticism, but then just kind of sidesteps why the consensus exists in the first place.
It just moves on.
Exactly. So the suggestion is to briefly give the skeptics their moment, talk about their concerns, but only so you can immediately show why they're wrong. It makes your own thesis feel earned, not just optimistic.
So how would that look in practice? What's a quick way to invalidate those conservative views without losing all that bullish momentum?
Well, you could briefly touch on factors like, say, SoFi's high valuation multiples compared to traditional banks. That's a common hang-up.
Right.
Or you could mention regulatory pressures in the fintech space. You bring it up, and then you explicitly state why SoFi's accelerating growth rates and raised guidance make those specific concerns less relevant right now. You show the reader you've already considered the downside and defeated it.
That's a really solid point. And speaking of proving that sky-high valuation, we have to talk about the catalysts. The material calls the new SoFi crypto launch a game changer, but the analysis feels purely qualitative.
It does, and that's the next big opportunity here. The argument really needs to quantify the near-term financial impact of this catalyst. Just calling it a big deal isn't enough.
Yeah, I mean, being the first nationally chartered, FDIC-insured bank to offer direct crypto trading is a huge strategic win.
It's massive. But strategic steps don't automatically equal immediate bumps in valuation models.
So the core issue is connecting that excitement, that game-changer energy, directly to the math that gets you to $38 a share.
Precisely. You have to anchor the catalyst to specific, estimated financial projections, or, at the very least, to its strategic effect on user economics.
Okay, so give me an example.
You could provide an estimate, even a rough one, of the expected incremental revenue percentage the crypto feature might add in the near term.
Or you could frame it another way, maybe around user retention. You could discuss how this integration potentially reduces customer churn or even acquisition costs.
Yes, exactly. That enhances the member lifetime value calculation, which is absolutely critical for justifying a high-growth valuation target like $38. That quantitative link is what's missing.
It is. Okay, so to wrap this up, there are really two key opportunities to make this analysis airtight. First, structurally integrate and then defeat the counterarguments to prove the thesis is truly robust.
And second, quantify the impact of that massive SoFi crypto catalyst. Move beyond the qualitative excitement and show its concrete financial contribution.
Right. Tie the story to the numbers.
Do those two things, and this investment case becomes incredibly powerful. So we'd encourage you to implement these revisions.
Absolutely. Give them a shot and feel free to submit the refined analysis back to us. Keep challenging your work.